We're going to be breaking down distressed properties and everything you need to know about financing them. Really important topic, I think, to break down all of the nuances of what we should be looking for if we actually want to secure financing on the properties.
Take a look at the real estate market today and how hot some of the prices are for these saleable condition type properties, and a lot of people look at and say, hey, I can't afford this, or it doesn't look like there's a lot of opportunity for a good deal here. When we take a look at distressed properties and how much potential equity there is to be able to be forced appreciated in this, it presents a whole new option for people to be able to find ways to build wealth through real estate.
Off-market deals are by far the highest ROI deals that we've seen for our clients. If you're able to purchase something really under market value and understand the cost and create that lift, you're going to make a ton of money.
What's going on YouTube? Welcome to the Canadian Real Estate Channel. My name is Lynn Matheson, aka the Canadian Cottage Girl, and welcome to an episode of the Findlay Finance Friday, where we're going to be breaking down distressed properties and everything you need to know about financing them. Welcome to the channel, Josh and Aaron.
Yeah, thanks for having us.
Absolutely. Well, I am excited to jump into this topic. Obviously, my kind of background in real estate investing has been a lot in distressed properties in the wholesaling space. So this is a really important topic, I think, to break down all of the nuances of what we should be looking for if we actually want to secure financing on the properties.
Yeah, I think, you take a look at the real estate market today and how hot some of the prices are for these saleable condition type properties, and a lot of people look at and say, hey, I can't afford this, or it doesn't look like there's a lot of opportunity for a good deal here. When we take a look at distressed properties and how much potential equity there is to be able to be forced appreciated in this, it presents a whole new option for people to be able to find ways to build wealth through real estate. Ideally, when you're buying a distressed property, either the price is already low enough, or you're able to negotiate a low enough price that makes it worthwhile for you to go in, spend the capital, because they are quite intensive in terms of the capital needed, force appreciate that property, and be able to either refinance out if you're doing a BRRRR, or flip that property for that profit if you're obviously doing a flip. There's lots of opportunities out there. We've all seen some of the pictures of the types of properties that are out there, and it really just requires someone who has a little bit of imagination and creativity to be able to see the potential there and realize how much value truly is in these properties. Now, when it comes to the financing side with distressed properties, it does create a bit of a tricky situation because the property, if it is distressed enough, can be in quite terrible condition. Most of the time you're not going to be able to get conventional financing, so it does require some sort of private option to be able to go in and close on the property. Now, when we're taking a look at a property and we're determining, is this distressed, or what type of situation is this property, and what is it, what is the situation for financing, there's really two things that we're kind of looking at. And the first one is, it basically just, is the property even complete enough to qualify for conventional financing? So the underwriting parameter that we really look at is 97% complete. So there's two ways that we can kind of determine if a property is 97% complete. If it's a new build, it's going to be done based off of a cost approach. So how much does it cost to build the house, and essentially what is that final purchase price? The seller or the appraiser is going to take a look back through all of the additional features, how much for the cabinets, the floorings, all that stuff. And essentially, as long as 97% of that cost to build is complete, that is, in their eyes, 97% complete. Now, if it's a resale property, it's already been built, essentially we're taking a look at just, is the house completely ready to live in? That last 3%, we're really looking at, sodding, driveways or walkways, and, perhaps if there's a deck on the back that, might be an addition. We can get away without those things, but all the major appliances, cabinets, floorings, plumbing, electrical, all that stuff has to be in the house, ready to go, ready to be livable, and that qualifies for 97%.
For sure. The second thing we look at with a distressed property is it livable, and are there any issues with the property? So mold, asbestos, is there UV insulation, is there knob and tube, is it completely livable in regards to sometimes even cleanliness? Like we have lenders who will take a look at properties that have maybe people who are hoarders or people who had just stuff everywhere, and your appraisal is a direct reflection of what the lender sees and how they make a decision. So unfortunately, if you go get an appraisal done on a property that's distressed, and you might not think it's distressed, but there's stuff everywhere and it's dirty, a lender doesn't have, I guess, the want to be able to give you financing on that deal. And this is where we run into some challenges with conventional financing.
Right.
Most investors know that off-market deals or deals with distressed properties, there's the most money to be made. When you're looking at purchasing these properties and you're looking to create that lift, sometimes you have to factor in the overall acquisition cost. And unfortunately, if you're not versed in purchasing these types of assets, it can be a little bit of a shock. So we wanted just to outline what that would look like and what some creative financing solutions that we've implemented in the past with our clients. So when you are looking at getting these properties, anything we just said, mold, UV, those are all red flags right away. If the wholesaler is going to let you know that there's issues with any of those things, that should be a red flag to let you know that you're probably looking at some sort of private financing solution.
Yeah, I think it's a good point when we're talking about, these properties are probably off market and there is no MLS listing. The best thing that you can do for your broker is provide them with any pictures that we can take a look ahead of time and, point out any issues and say, hey, there's going to be problems with this. Yeah. As a heads up, you're probably not getting conventional financing. With some of these issues, sometimes if there's mold or maybe there's a little bit of water damage, depending on how that appraisal comes back or maybe your inspection report comes back, sometimes we can still get conventional financing if it's a very small issue. If there's just a little bit of mold above the shower tub and that can be remediated quite quickly, maybe the lender just does a holdback. So what they're going to do is, let's say it costs $5,000 to remediate the situation. The lender is going to hold back $5,000 of your mortgage. So you're going to have to come up with that $5,000 on closing. Once you've remediated the situation, an inspector goes in and gives you the all good. You can go back to the lender. They're going to release those funds to you with the appropriate sign off, and then you're going to get your money back. If you're in a situation where you're doing maybe an insured or insurable type file, we can take a look at a purchase plus improvement so we can build those costs into your mortgage. Again, this is really on some minor things. If you've had fire damage to your property or there's huge structural issues, you're not going to get a holdback. You're going to have to close privately, get those remediated and fixed, and then we can refinance back out. But having those pictures and having that knowledge ahead of time is going to save us a lot of time. If we go through a conventional purchase process and we don't have any pictures and the property is a disaster and we're 3 weeks in and you got a week to close and the appraisal comes back and it looks terrible, well, now we don't have a whole lot of time to be able to flip and find an alternate situation. So having those pictures up front really does a lot and allows us to be able to make those decisions ahead of time. On the appraisal, like Josh said, there's two things. One, it's up to the lender whether or not they want to move ahead on the property. The appraisal could go back with average or above average condition and is good to go in the appraiser's eyes, but if the lender just doesn't like the look of the pictures, they can say no. Just because they've given you a commitment doesn't mean they have to follow through with that. They can pull out even if it's 2 days before closing. And then the other part to that is it is up to the appraiser. So if your property doesn't come back in at least average condition and it comes in at fair or poor condition, the lender's automatically going to say no. Even if there isn't any real issues of fire, mold, whatever it is, etc., knob and tube, and it comes back below average condition, and a lender is automatically going to say no to the property. So even though you in the eyes of the investor might think this is a perfectly good property, it's livable, the appraisal comes in and it doesn't match up, the lender is going to walk away from that. And again, it could be a week, could be 2 weeks, could be 3 days before, depending on the timeline. So really important.
Yeah, I think it's really important as an investor to understand too the severity of these specific things. Again, if it's a little bit of mold, probably not super severe. We could probably find a solution to get it done. If it's serious fire damage or flood or issues with the foundation, those are serious things. You need to make sure you're pricing in those things into your purchase price. So it might not be your first one. You might not understand the total cost of being able to deal with foundation issues. I've had clients come to me say, oh yeah, it's a really good deal, but it says foundation issues, but it's sight unseen. You're rolling dice. At the end of the day, there could be some serious issues with foundation. So understanding to price that in is really important, because at the end of the day, even even private lenders price in serious structural issues into their pricing, and it might be even difficult to get financing on some of these really distressed properties. Now, private financing is equity lending, so it's, at the end of the day, it's what is the value of that asset and how much money am I able to give you on that asset. So their valuation on something that has serious structural issues might be different than what you actually purchased it for from a wholesaler. So just understanding the severity of it, the cost of fixing it, is really important. We see quite a few newer investors looking at off-market properties, not maybe quite understanding how much it's going to cost. When you have a $20,000 budget and you're like, oh, I can deal with that. That's, you're probably not putting yourself in the best situation to succeed. So, understanding how distressed your property is. Off-market deals are by far the highest ROI deals that we've seen for our clients. If you're able to purchase something really under market value and understand the cost and create that lift, you're going to make a ton of money. But even private financing, sometimes there are limits as to what you can achieve.
Yeah, the type of lender on the private side too is going to make a huge difference. Like if you're trying to take this to a mortgage investment company, something that has, a board of directors and policies that they have to follow, they're probably less likely to close on this, terrible property versus an independent, true private lender who just wants to put out money. And some of these private guys, they usually get their money from real estate investing, so they understand. So we have specific private guys who know how to deal with fire damage or know how to deal with, maybe it's a property down to the studs and you're going to do an addition. So we have guys that understand specific situations and like specific situations, and who will lend money in these, unique types of properties.
Yeah, I think there's like a tier of distressed property, and if you have a minor distressed property, you could probably get a mortgage investment corporation. It's going to give you flexible financing. If you have some sort of maybe open terms, it's not going to cost you a lot to break your loan. It might be decent fee and rates. But if you have a really distressed property, lender might not be as apt to give you an open term after 6 months. They might want to actually lock in that that income. If you are doing a flip, they might want 3 months prepaid interest to ensure that they're getting paid and you're not just paying it out right away. There is risk involved in being able to do these types of properties. So sometimes it can be priced in depending on how distressed the property is.
Yeah, I definitely appreciate the context there. Oftentimes there is a scale, and also doing your own due diligence on these properties sounds like it's very important, and taking really good, clear photos so that there aren't any surprises when that appraiser goes through, and you can actually fully understand what's going on in that property, and just account for it, right? You just want to budget for those things. Most problems can be fixed, it's just at what cost, and from that perspective, that has to be accounted for when you're seeking funds. And I definitely appreciate the scale there, and I definitely did not realize it was 97% complete for some of those A lenders in terms of what they're looking for. So it's definitely important that you fully understand the scope of the project and kind of break it down with your lender. Another point that I think is really important to highlight that you mentioned there, Josh, is your lender can actually connect with different private lenders. And this is a point that I've said many times, but I want to hammer home is make sure that you source out the right mortgage agent. And the Findlay team is one of the teams, well, the team in Canada that is actually focused on real estate investors and finding solutions for real estate investors. So they're able to actually get some of those deals financed that other mortgage agents or other lenders definitely would not be able to, because they've built connections with people who own mix, with people who finance on certain specific types of projects. So I think it is really important that you understand who you're working with and what they're focused on, because not every mortgage agent is created equally, and you want one that's going to go to bat for you. With the distressed properties as well, understanding where it's coming from and all of the numbers is really important. Do your own due diligence. Always trust but verify, and actually break down the numbers yourself, because from one investor to another, it might look a little different in the way that you approach the situation or your cost, depending on how you can source material or depending on who your connections are. So it is really important that you are building your team and doing your own due diligence for these properties.
Completely agree. I think when you're looking at these types of properties and this type of capital, it's important to understand the flexibility that we have with being able to find solutions. You don't necessarily need to put a very large down payment down if you have other tools in your tool belt. So I know we've made a bunch of videos on cross collateral. This is a great solution to be able to help people get into these really distressed properties, because if you have equity in a property that is in really good condition, a lender might use that equity and feel more comfortable with lending to you on a really distressed property, because you're able to reduce that risk for them. So we find that using cross collateral is a really great way for the really bad properties.
Right.
It also would allow you to be able to source capital to actually do the renovations as well, and it allows you to get higher loan to value that most lenders probably wouldn't allow you to be able to do. So understanding that there is different types of capital out there and the options that you have available for these types of assets is super important.
Okay, so how does an investor go about ensuring that they can get the most out of the financing for this distressed property? So what are the actual things? Say Rebecca is buying a distressed property. What do I need to do both on the purchase side as well as the refi side in order to really optimize my returns?
Yeah, so I think in any situation where you're doing any sort of work to the property and you're improving the value, especially if you're looking to refinance that property, is just keep track of all the work that you're doing, keep all your invoices, keep all your receipts, take before and after pictures. The more documentation that we have of physical forest appreciation to the property, the easier it's going to be to be able to refinance that property, especially if it's in a short time period. If you're looking to do a refinance in like 4 to 6 months, it's already difficult as it is, especially if you're buying a property at $200 and you're trying to refinance it at like $450,000, $500,000, right? They're going to want to know, why is this property all of a sudden worth $300,000 more? We can show them that you put $200,000 into the property. Here's all the receipts. We're trying to get this guy his money back. Here's the proof of the money that he spent, before and after pictures. That makes it a lot more believable and a lot easier of a situation than just, well, he bought it at here and now it's worth this, but I don't have any, I don't have anything to show you why. So, it's all about creating that story and explaining it and showing clear proof to the lender. If you're not looking to flip it and you're looking to BRRRR it, we have to make sure that you're going to be able to afford that increase in appreciation of the property. It's one thing to be able to afford the property at $200,000, but again, if you're refinancing at $500,000, that might be beyond your abilities of A side lending. We might have to take a look at B side lending. We might have to take a look at small commercial financing and removing that aspect of personal debt servicing altogether. So if you're BRRRRing, it's important to run the numbers ahead of time to know that you're going to be able to afford this property. Or if you can't afford it in A, B, or C, you're going to have to flip this property or find someone else to come on the application with you at the end to help refinance. So, it's great if you put all this work in and lock up $200,000, but if you can't afford that refinance and you're stuck and all that money's trapped, now you've just tied up capital and you're not going to be able to move on to your next project. So making sure ahead of time that you can afford it, is a key part of that solution, especially if you're getting into private financing as well too. You definitely don't want to be trapped at 10% money and stuck renewing until you can find a way to get out. So doing the due diligence ahead of time, like you said, on the property itself, but also talking to us or a mortgage broker if you're working with one, making sure that refinance is available and the numbers look good.
Awesome. Definitely appreciate that, guys. Anything else that you want to add in here about distressed properties?
It's a great way to be able to pick up properties on the cheap. As the motto goes, problems are profit. You're probably going to find a ton of problems with these properties. You're going to make way more money purchasing these properties and force appreciating them. It's a tried and true investment strategy. There are opportunities everywhere to be able to take on these properties. Just understand what you're getting into, the scope of work you're actually going to have to do to the property, and your financing options, as Ehren said. It's easy to buy properties. Acquisition's pretty easy, whether it's private financing or whatever that looks like, but executing on your strategy at the end. So do you qualify for the property is probably the most important thing on your takeout financing, because if your exit strategy doesn't work, the entire strategy doesn't work. So just understanding what that looks like, and taking advantage of the market that we have.
Absolutely. Well, guys, thanks for tuning in for another episode of Findlay Finance Friday. If you liked today's video, make sure you like, subscribe, and comment below and let us know what you thought. As well, if you're interested in some off-market deals, subscribe to our off-market buyers list. mattmckeever.com/private deals is where you can find them. We'll put a link in the description below as well. And if you like today's video, we've got more. Every Friday we have Findlay Finance Fridays as well. Josh and Erin actually have their own YouTube channel, the Findlay Mortgage Team. Check it out. Hop on over. We'll make sure to link their channel as well in the description, and check out more content like this. The Findlay team is focused on investors, and that means that they are going to find solutions for you and work with you every step of the way, whether it be in the buy, in the refi, or if you're looking to flip the project. They'll help you work through the whole scope of what your goals are and start from the beginning all the way to the end of the project. So thanks again for tuning in, guys. We'll see you on the next one. Cheers.